Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Amazon.
If you find our talks useful, please consider subscribe, like, and comment underneath. So, let's just get right into it. If you owned a business that just generated a record $77 billion in pure profit, you'd probably throw a massive party, right?
Oh, absolutely. Anyone would.
Right. But if you're Amazon, you take almost every single dollar of that cash and you immediately just bury it in the ground to build these massive AI factories.
Yeah, it's pretty staggering to watch.
It really is. So today we're answering one fundamental question for your portfolio. Is this $200 billion spending spree, the greatest wealth-building land grab in the history of the global economy, or is it just a terrifying, reckless gamble?
It's exactly the right question to ask because, honestly, you simply cannot evaluate this company using traditional retail frameworks anymore, or even standard tech frameworks for that matter.
The old models just don't apply.
Exactly. We are watching capital move at a velocity and scale that basically breaks conventional modeling.
Yeah.
To understand where this stock is going over the next 3 to 5 years, you really have to understand the physical infrastructure they are quietly taking over.
Okay, so let's start with the raw numbers from fiscal year 2025, because they kind of set the baseline for all of this.
It's a place to start.
Total net sales reached $716.9 billion.
Which is a 12.4% year-over-year increase, just to put that in perspective.
Right. And net income hit an all-time record of $77.7 billion. To put that in investor terms, that's $7.17 per diluted share.
Yeah, meaning if you divided all that pure profit by every single share of stock in existence, each share represents over $7 of actual earnings power.
Which is incredible. But the real engine here, the thing driving all of this, is AWS, their cloud computing division. Q4 2025 revenue for AWS hit $35.6 billion.
Right, and that represents 24% growth, which, by the way, is their fastest growth pace in 13 quarters. That brings AWS to an annualized run rate of $142 billion.
Let's define run rate real quick, just so we are all on the same page. That essentially means taking their most recent, highly successful quarter and projecting it forward for a full 12 months, right? Like to capture their current momentum.
Precisely. It gives you a snapshot of exactly how fast the engine is turning over today, rather than just looking at old historical data.
Got it.
And within that AWS growth, there's a specific sub-metric that alters the entire thesis, and that's the generative AI run rate. By the first quarter of 2026, that specific segment hit a $15 billion run rate.
Oh, wow. $15 billion just on AI.
Yeah. And to provide some context there, this AI segment is scaling nearly 260 times faster than the early days of AWS itself.
Wait, seriously, 260 times faster?
Yeah, it took their traditional cloud business years to achieve the revenue scale that their AI business just reached in a matter of months.
That's just insane. So the money is pouring in at record speed. But here is the massive contradiction we have to unpack. The free cash flow.
Ah, yes. The CapEx shock.
Exactly. For anyone new to the term, free cash flow is the actual cash left over after a company pays for all its operating expenses and the capital expenditures needed to maintain its assets. In 2024, that number was a very healthy $38 billion.
Right.
But in 2025, it plummeted to just $11.2 billion. And the culprit is a $50.7 billion surge in property and equipment purchases, mostly these new AI factories.
Which is a huge jump.
And now they are guiding for a jaw-dropping $200 billion in capital expenditures, or CapEx, for fiscal year 2026. I have to stop you there and push back a little.
Go for it.
To a retail investor, seeing free cash flow drop by 70% in 1 year is a giant red flag. It's like a wildly successful restaurant taking all its record profits to build 10 more kitchens overnight. Are they just setting money on fire, hoping AI eventually pays off?
I get why it looks that way. It is a highly aggressive, deliberate contraction of cash flow, but it is not reckless. You have to look at how the balance sheet absorbs that blow.
Okay, so what metric should we be looking at instead?
The metric to watch is operating cash flow, which, by the way, remains incredibly robust at $139.5 billion.
Wow, $139.5 billion.
Yeah, that is the cash generated purely from their core day-to-day business operations before they make those massive infrastructure investments. That massive operating cushion allows them to fund this $200 billion CapEx guidance entirely internally.
Right, without taking on dangerous levels of debt.
Exactly, without jeopardizing their financial health at all.
So they aren't going to the bank to borrow money to build these factories. They're just taking the massive profits from their core operations and handing it straight to the construction crews.
Basically, yes.
But what exactly are they buying with $200 billion? Are they just calling up NVIDIA and ordering millions of standard chips like every other tech company?
No. And that is exactly where the competitive moat begins to form. They are not just buying off-the-shelf servers. They are vertically integrating the entire AI stack.
Meaning they're building the hardware themselves.
Exactly. They are manufacturing their own proprietary silicon chips, specifically the graviton, tranium, and inferential lines. This custom silicon business just passed a $20 billion annual revenue run rate on its own.
I want to dig into the mechanics of that, actually, because building semiconductors is notoriously difficult and expensive. Why bother? Like, why not just outsource the hardware to the established hardware giants?
Because of the unit economics.
Yeah.
Think of it like operating a massive global taxi fleet. If you buy your cars directly from a major auto manufacturer, you pay their profit margin, and you get a generic car built for everyone.
Right. It has all the standard consumer stuff.
Exactly. It has a nice stereo, leather seats, and features a taxi driver doesn't really need. But if you design your own vehicle specifically to be a taxi, you strip out the stereo, you strip out the leather seats and all the useless features.
You make it incredibly cheap and highly efficient.
Exactly. That is what AWS is doing with its Trainium chips. A standard third-party GPU is an amazing piece of hardware, but it is built to do everything, including processing high-end video game graphics.
Ah, so they are stripping out the generic features to make a lean, hyper-efficient AI machine.
Yes. By designing custom silicon purely for running massive AI language models, AWS achieves 30 to 40% better price performance than third-party GPUs.
That's a massive discount at scale.
It is. And they are doing this down to the 3-nanometer silicon level.
Wait, 3 nanometers? That's tiny.
Very tiny. In chip manufacturing, nanometers measure the microscopic distance between transistors. A 3-nanometer chip means they are packing billions more transistors into the exact same physical space.
So the data doesn't have to travel as far.
Exactly. The mechanism here is simple. Shorter distances mean data travels faster while consuming significantly less electricity.
And electricity is a huge cost for data centers.
A massive cost. So over a massive data center, that efficiency saves them tens of billions in capital expenditures annually. It adds hundreds of basis points, meaning full percentage points of pure profit to their operating margins.
Okay, so the cloud infrastructure is becoming this hyper-efficient, highly profitable machine, but we cannot ignore the physical retail side of the business, right? Because it's undergoing a similar transformation.
Oh, absolutely. The retail side is completely shifting.
North American retail margins just hit a record 8 to 9%. Historically, retail operates on razor-thin margins. How did they suddenly make shipping cardboard boxes so profitable?
It comes down to a strategy called regionalization combined with advanced robotics. Historically, if you lived in Seattle and ordered a specific blender, it might have been sitting in a warehouse in Ohio.
They'd have to fly it out.
Right. They had to put it on an airplane and fly it across the country to get it to you in 2 days. That is incredibly expensive. But recently, they've fundamentally restructured their logistics. They divided the United States into 8 autonomous, self-sufficient zones.
Oh, so the goal is to just keep the inventory within your specific region.
Exactly. By doing this, they effectively cut out expensive air freight entirely. The packages just move via local trucks.
So they eliminated the most expensive leg of the journey.
Yes, that's exactly.
And alongside that regionalization, they are quietly dominating a massive new advertising sector. They now control 79% of the retail media market.
Which is just staggering.
Right. For context, this is a market projected to reach $108 billion in 2026.
It is an absolute powerhouse.
Yeah.
Retail media allows brands to place ads directly at the point of purchase, which has an incredibly high conversion rate compared to a standard search engine ad.
So let's connect these pieces, because this is where the lock-in effect seems genuinely dangerous for competitors. They have custom hardware making AI cheap on one side, and they have an inescapable advertising marketplace on the other. But history is littered with massive tech companies that tried to build walled gardens, only to watch their clients demand flexibility and just leave. What actually stops an enterprise developer or a major retail brand from just migrating their business to Microsoft or Google if they get frustrated?
The mechanism stopping them is economic gravity. The switching costs are practically insurmountable.
How so?
Well, if a developer builds their AI models on AWS using those proprietary Trainium chips, they're locked into that 30 to 40% cost efficiency. Moving to a competitor means voluntarily destroying their own profit margins.
He says they'd be paying for the expensive third-party chips again.
Exactly. And on the retail side, a brand simply cannot afford to leave an advertising network that controls nearly 80% of consumer purchase intent. It is a dual-sided moat. They capture the infrastructure spending of the tech world and the advertising budget of the consumer world.
Because they are engineering this total economic lock-in, Wall Street is being forced to completely reevaluate what this company is actually worth. And that reevaluation has looked like a roller coaster over the last 6 months.
It really has. The price action early in 2026 was a textbook example of a capex shock.
Walk us through that timeline.
Sure. Back in November 2025, the stock hit an all-time high of $258. But when the market fully digested the reality that management was seriously going to spend $200 billion on physical infrastructure, panic set in.
Yeah, investors punished the stock. It went into a 10% pullback, dropping down to the $199 to $210 range.
Right. The market was essentially demanding proof that this cash bonfire was actually going to yield a return. Nobody wants to see free cash flow vanish without a receipt.
Exactly. But then sentiment violently shifted in mid-April. CEO Andy Jassy released his annual shareholder letter, and that was when he dropped the critical metric we discussed earlier, the $15 billion AI run rate.
Which was the proof the market was demanding.
Right. The market suddenly realized the AI investments weren't just speculative research. They were already generating massive, tangible revenue. The stock surged over 5% in a single day, pushing the market cap firmly past the $2.5 trillion mark.
And today it's trading right around the $249 to $250 level, looking at a potential breakout.
That 5% single-day surge is what the industry calls a validation moment. And looking at the analyst community, the consensus is overwhelming right now. 92% of analysts currently maintain a buy or strong buy rating.
Yeah, and you have firms like Stifel Nicolaus maintaining a target of $294 and BofA Securities targeting $275.
And it isn't just analysts issuing price targets, right? Massive institutional money is physically moving into the stock. Vanguard, BlackRock, and billionaire Bill Ackman's Pershing Square have all been heavily accumulating shares.
Yeah, they're treating this as the ultimate all-weather AI play.
But I have to play the contrarian here for a second.
Please do.
When I hear that 92% of analysts are screaming buy and every major institution is piling into the exact same trade, that usually means perfection is already assumed by the market.
It definitely raises the risk profile.
Right. Let's look at the forward price-to-earnings ratio. It is sitting at 37.9. For anyone new to that metric, a traditional mature value company might trade at 15 times its earnings. At almost 38, the market isn't paying for what the company is doing today. They are paying a massive premium for flawless execution tomorrow.
Absolutely. Any crack in that execution means a steep drop.
So what actually breaks this thesis?
You are entirely right to be skeptical of a crowded trade. So let's unpack the bear case, starting with the biggest operational risk, the capex overbuild.
The ghost data centers.
Exactly. We talked about the $200 billion being poured into AI factories. But what happens if enterprise adoption of AI hits a wall? What if companies realize they don't actually need massive language models to run their basic operations?
Then demand falters.
Right. If demand falters, they are left with what the industry calls ghost data centers. Stranded capital that generates absolutely no return. And that would completely crush that premium 37.9 multiple.
It's like a real estate developer building a sprawling luxury neighborhood. They pave the roads, lay down the plumbing, and build 100 beautiful mansions. But what if the housing market crashes and nobody moves in? You are just bleeding cash, paying property taxes for an empty, silent city.
Exactly. It's a terrifying prospect.
Yep.
However, the counterpoint to that risk, and honestly, the reason those institutions are so willing to buy at a premium, lies in the backlog.
Let's talk about that backlog.
Unlike speculative real estate, this infrastructure build is entirely demand-led. They're currently sitting on a massive $244 billion backlog and over $100 billion in direct signed customer commitments.
Okay, so to use the real estate analogy, the foundation of the neighborhood hasn't even been poured yet, but every single house is already pre-sold. The buyers have already signed the contracts.
Precisely. They're not building ghost towns. They are building capacity that is monetizing almost as fast as it can be physically installed.
That's a huge mitigating factor.
It is. But there is a second major risk we must analyze that operates completely outside of supply and demand: regulatory risk.
Right. The Federal Trade Commission, Project Nessie.
Yes. The FTC monopolization lawsuit has a bench trial scheduled for October 2026. This is a significant overhang for the stock.
What exactly are they alleging?
The FTC alleges that the company used a secretive algorithm called Project Nessie to artificially manipulate and inflate prices across the broader internet, basically testing how high competitors would follow and then dropping prices to crush them if they didn't.
Wow. Okay.
Furthermore, the lawsuit targets the integration of their retail marketplace with their logistics network. They allege that the company essentially forces third-party sellers to use their fulfillment services to get premium placement on the site. An adverse ruling could theoretically force structural changes like decoupling the marketplace from the logistics arm entirely.
And if they are forced to decouple those two arms, that record 8 to 9% retail margin we discussed earlier could severely compress.
Absolutely.
However, looking at our sources objectively, and we are looking at this strictly analytically, just analyzing the pieces on the board, there is a very interesting counter-dynamic at play regarding regulatory pressure.
The government contracts.
Yes. The company recently entered into a $50 billion government AI investment. This deeply integrates their custom silicon and secure cloud infrastructure directly into the United States national security and intelligence apparatus.
It's a massive partnership.
Right. So from a purely objective standpoint, some analysts argue this creates a form of political air cover. The logic is that when a company becomes the critical backbone of a nation's sovereign defense infrastructure, it heavily complicates the likelihood of draconian regulatory outcomes, such as a forced corporate breakup.
It creates an incredibly complex web of dependencies. You have the regulatory arm scrutinizing their retail dominance, while the defense and intelligence arms are becoming entirely reliant on their cloud dominance.
It's a massive tug of war.
Definitely. For your portfolio, it means watching that October 2026 trial date very closely, but also understanding the broader geopolitical reality of the company's operations.
Okay, so we have mapped out the massive cash flow funding its own expansion, the dual moats of silicon and retail, and the regulatory risks. Let's look at the immediate calendar. Over the next 3 months, what are the specific catalysts, investors need to be watching?
First is the Q1 2026 earnings report, which is expected in late April or early May. The critical metric to watch there will be their operating income guidance, which is currently set between $16.5 billion and $21.5 billion.
So the market wants to see if they can hold those margins.
Exactly. The market will be aggressively watching to see if they can maintain those high operational margins while simultaneously deploying billions in CapEx.
Got it. Another massive macro trend to monitor is the shift toward agentic AI. This is basically phase 2 of the generative AI boom.
Right, moving beyond just chat.
Exactly. Instead of just a chatbot that answers a question, enterprise companies are deploying autonomous AI agents that can actually execute complex, multi-step workflows, like booking flights, running payroll, or auditing code without any human intervention.
It's the industrialization of AI.
Yes, and that industrialization is driving massive, high-margin workloads away from local on-premise servers and directly into the AWS cloud. But I have to admit, looking at the upcoming catalyst, there was one detail that just completely threw me off.
I'm guessing you mean the satellite broadband network.
Yes. I mean, why on earth is an e-commerce and cloud computing giant suddenly picking a physical fight with SpaceX in low Earth orbit?
It does seem pretty far out there.
Literally. They recently closed the acquisition of Globalstar. They have major FCC milestones coming up in July 2026 for the commercial rollout of AMZN Leo, their satellite network. They even tested it recently to broadcast professional golf tournaments. It just seems completely disconnected from retail and cloud software. Why are they launching satellites?
It actually makes perfect sense when you look at the mechanics of edge computing. It is the ultimate physical extension of the cloud.
How so?
Well, AI models require massive amounts of real-time data from the physical world. Think about autonomous vehicles navigating cities, or remote industrial mining sites, or global shipping fleets.
So they need a connection.
Right. Historically, if you rely on traditional telecom infrastructure to get that massive volume of data back to an AWS data center, you encounter latency delays, high costs, and security vulnerabilities.
So the satellites fix that.
Exactly. By launching AMZN Leo and acquiring Globalstar, they are building a proprietary closed-loop pipeline from space directly into their data centers. They are bypassing the public internet entirely.
That is wild.
is a direct challenge to SpaceX's Starlink, ensuring that AWS enterprise customers have ubiquitous global connectivity perfectly integrated into their existing cloud contracts.
They really are trying to own every single physical layer of the internet stack, from the 3 nanometer custom silicon chip processing the data on the ground, all the way to the satellite beaming it down from space.
That's the vision.
Right.
And we are seeing deep strategic partnerships validating this infrastructure dominance too. They are deepening ties with Oracle, for instance, a company that was traditionally a fierce rival.
Which is a huge signal. And beyond that, there are some massive speculative rumors floating around Wall Street right now.
We should clearly note these are unconfirmed rumors, of course, but the institutional chatter is significant enough to monitor.
Very significant. The first rumor is a potential $100 billion infrastructure partnership with OpenAI spanning the next 8 years.
Right. If that materialized, it would be a paradigm-shifting alignment in the AI space.
Absolutely. The second rumor is a retail expansion called Prime for Health, speculating that they will bundle their One Medical acquisition and pharmacy branch into a unified subscription-based healthcare service.
Both of those rumors, if true, point to the exact same underlying mechanism, expanding the physical and digital surface area of the ecosystem so broadly that leaving it becomes practically impossible for a consumer or an enterprise.
So let's synthesize this for the listener's wealth building strategy. For a very long time, we thought of this company as, the place you go to buy cheap batteries with free 2-day shipping. But that era is effectively over.
It is. The staggering $200 billion capex shock is real, and it absolutely suppresses free cash flow in the near term. But for investors looking at a longer time horizon, say a 3 to 5 year hold, this period should be viewed as a foundational accumulation phase.
Because it takes time to build.
Exactly. Massive capital expenditures take anywhere from 12 to 24 months to fully monetize and appear on the income statement.
Yeah.
You are looking at a structural margin inflection point projected for 2027 to 2028 when these AI factories are fully online and generating high-margin software revenue.
You have to survive the construction phase if you want to collect the rent on the finished building.
Exactly right.
Which leaves us with one final deeply provocative thought to mull over. We have spent the last 20 minutes dissecting an entity that designs its own 3 nanometer silicon chips. It provides the core cloud infrastructure for the global enterprise world. It hosts the autonomous AI agents running those businesses.
Right.
It operates the retail marketplace. It controls an inescapable advertising network. It is moving aggressively into personal healthcare. And it is now literally launching satellite constellations to beam its own private internet down from space.
It's almost hard to comprehend.
It really is. At what point do we have to fundamentally change our definitions? At what point do we stop analyzing this entity as a traditional publicly traded company and start having to view it as a sovereign digital economy? Thanks for joining us, and we'll see you next time.